Markets in 2026 are not behaving like people want them to behave. There is still this belief that liquidity will always return, that central banks will always rescue risk assets, and that downturns are temporary inconveniences rather than structural parts of the system. That is not how markets work. What actually drives markets is cycles. Credit cycles, interest rate cycles, liquidity cycles, and human behavior cycles. Those do not disappear because sentiment improves or because technology advances. They persist across decades. We are now in an environment where capital has a real cost again. That changes everything. For years, money was essentially free. That shaped behavior in a very distorted way. Companies borrowed excessively, investors chased growth at any price, and risk was mispriced across almost every asset class. Now that interest rates are structurally higher than the post-crisis era, the math is different. Debt matters again, cash flow matters again, and discipline matters again. That is not theory, that is reality showing up in earnings, refinancing pressure, and capital allocation decisions. One of the biggest mistakes investors make is confusing stability with safety. Markets can be calm for long periods while risk is building underneath. Low volatility is not a signal that everything is fine. Often it is a signal that leverage is increasing and complacency is rising. You see this clearly in equity markets today. A small number of large companies continue to dominate index performance. That creates a narrow market structure. When leadership is that concentrated, the system becomes more fragile, not less. People look at indexes and assume the market is healthy, but indexes can hide weakness underneath. Breadth matters, participation matters, and when those weaken, corrections tend to be sharper when they come. Another important point is that markets are still digesting the consequences of the last decade of ultra-loose monetary policy. It takes time for excess liquidity to unwind. It does not disappear instantly. It flows through credit markets, real estate, corporate investment, and eventually equities. Equities are usually the last to adjust, not the first. That creates a delay effect. Investors often misread that delay as resilience, when in reality it is just timing. There is also too much confidence in the idea that technology alone will prevent downturns. Artificial intelligence, automation, and productivity tools are powerful. They will reshape industries, but they do not eliminate economic cycles. Every generation has had a dominant narrative. In the late 90s, it was the internet. That period created enormous value, but it also created excess speculation. Both things were true at the same time. We are seeing a similar dynamic now. Strong innovation does not justify unlimited valuations. At some point, earnings must support price. That relationship does not change. Credit conditions are another area that deserves attention. When credit is too loose for too long, risk accumulates in places that are not immediately visible. It shows up in covenant-light lending, in overextended balance sheets, and in weak underwriting standards. The problem is not that these risks explode immediately. The problem is that they build quietly until something forces repricing. That repricing can be sudden. Banking systems today are stronger than before the financial crisis. Capital buffers are higher, stress testing is more rigorous, and oversight is more developed. That is a good thing, but it does not eliminate risk. It only changes how risk appears. Risk today is more about market behavior and liquidity than solvency in the traditional sense. That distinction matters. Liquidity can disappear quickly, even when institutions are technically solvent. Inflation is another structural factor that markets sometimes underestimate. Even if headline inflation declines, underlying pressures remain in wages, energy transition costs, and supply chain restructuring. That means central banks may not be able to reduce rates as aggressively as markets tend to expect during downturns. And if rates remain higher for longer, equity valuations need to adjust accordingly. This is simple discount math. Future earnings are worth less in present value terms when discount rates rise. That is not opinion, that is arithmetic. Another issue is fiscal policy. Government borrowing has increased significantly across multiple economies. In the short term, that supports growth and stabilizes demand, but over time, high deficits require either higher taxes, slower spending, or more inflation pressure. Markets eventually force discipline. They always do. The timing is uncertain, but the direction is not. Retail participation in markets is also much higher than in previous cycles. That is not inherently negative. Broader participation can be healthy, but behavior matters more than participation. When too many investors chase the same trades at the same time, momentum becomes crowded. Crowded trades can last longer than expected, but they always unwind eventually, and when they unwind, they move quickly. One of the recurring lessons across every cycle is that people extrapolate recent conditions into the future. When markets go up for long periods, people assume they always will. When volatility is low, people assume it will stay low. That is not how systems behave. Regime changes are subtle at first. They are not obvious in real time. Only later do they become clear in hindsight. That is what makes them dangerous. We are in a regime where returns are likely to be more uneven. Not everything will move together. Winners and losers will diverge more sharply. That requires more selectivity and more discipline from investors. Passive strategies worked extremely well in an environment of broad liquidity expansion. That environment is not guaranteed to repeat. Going forward, dispersion matters more. Stock picking matters more. Risk management matters more. There is also a psychological component to markets that cannot be ignored. After long bull markets, investors become conditioned to buy dips aggressively. That works until it doesn't. The danger is not optimism. The danger is untested optimism in the face of changing conditions. Markets always reintroduce risk in ways that feel unfamiliar when they arrive. And when that happens, people often say it was unpredictable. In reality, the signs are usually there. They are just ignored because the recent past feels more reliable than it actually is. So when I look at stocks in 2026, I do not see collapse. I see adjustment. I see normalization. After an extraordinary period of monetary distortion, I see a system recalibrating to a higher cost of capital. That process is not smooth. It never is. It involves volatility. It involves repricing. And it involves periods where sentiment moves faster than fundamentals. The key takeaway is simple. Respect risk. Respect cycles. And do not assume that calm conditions mean permanent stability, because markets have a long history of reminding people otherwise, and they tend to do it at the moments when confidence is highest.